Hi everyone. In this video, we are going to talk about HCL's Q2 results. The major headline of this result is they have said 3% revenues are from AI, which sounds interesting. Let's see what exactly is going on in this company. Uh, so the revenue has gone up 10.7% year on year, whereas on a quarterly basis, it has gone up 5.2%, which is really good for a large company that is generating revenues in billions of dollars. So EBIT is at 5,550 crore. So margin has improved to 17.4%, which is a 1.16% rise quarterly basis. So net income is flat year on year, whereas it is 10.2% up on a quarterly basis. So overall, HCL results have met expectations. There is no disappointment in terms of numbers. Whatever the street expected, it was met by HCL. So let's look at the revenue mix. So services, 91.2% of the revenue. It grew 5.5% year on year. HCL is one of the very few software services companies that has really built some software products and are generating some revenues from there that are meaningful and significant. So here you can see that 9.1% of revenue is coming from their product. So ARR at $1.06 billion, which is huge. But the growth has slowed down 0.6% YoY, but still this is a significant achievement for an IT services company. So the next one is digital. So digital transformation is one big thing which is generating tons of revenues for these companies. So HCL long back, a few years back, focused more on digital transformation, and because of which 42% of services revenue is digital. So it is up 15% year on year. They are doing something similar on the AI front. They are investing heavily on AI. They are looking to get more revenues from Gen AI related projects. So they are good at execution. They've already done that successfully through digital transformation revenue and grew the company. Maybe it is possible that they may do well in AI revenues as well. So let's look at the profitability. So they had a lot of costs due to restructuring, because of which there is a 0.5% margin impact. So it's at 17.4%. So return on invested capital is at 38.6%, which is up by around 3%, which is good. So free cash flow to net income is again very healthy. So very strong cash. So that is why if companies like TCS, HCL, Infosys are available at a cheap valuation, their dividend yields, their cash reserves and balance sheet, all of them make them attractive at lower price points. That is why these companies continue to remain a decent investment opportunity at corrections. So let's look at the booking. So they have a new deal TCV of $2.57 billion. It is up 16% year on year. This is a record high, and there aren't any mega deals. So all these are mid-sized deals with which they have been able to generate total contract value of $2.57 billion. So their $100 million plus clients are 22, and $20 million plus clients grew to 151. So the top five clients continue to contribute 12.4% of the revenue. Overall, it looks stable in terms of bookings and clients. So let's look at the people metrics. So attrition is one major challenge in all these IT companies. So they have a headcount of 2.26 lakhs, added 3,500 employees, added 5,000. So net add of 3,500. They added 5,196 freshers this quarter. So attrition has come down from 12.9% to 12.6. So now this is the most important slide, guidance. So FY26 revenue growth guidance is 3 to 5% in constant currency terms, which is fairly stable. Services growth 4 to 5%. EBIT margin, they are maintaining the same rate, 17 to 18% range has been maintained. So overall, the guidance does not look weak. It does not look optimistic as well. So for the whole year, the guidance is just about decent, which means that the company will continue to show decent quarters in the in this financial year of FY26. So the guidance may change as well. So let's look at the AI momentum, which is basically happening in the company. So 3% of total revenue has now come from advanced AI-based projects, $100 million plus. So they do a lot of things within AI. So they have AI services, which include Gen AI, agentic AI, building agents for companies, physical AI, and they also do AI advisory. So they have partnerships with Microsoft, Google, Dell, MIT, and Pearson to deepen AI-led offerings. So they are recognized as number one CX star performer in ISG generative AI services. So they continue to remain optimistic about AI. Just like I mentioned, digital transformation, digital revenue is 40 plus percentage of their IT services revenue. Similarly, they may have a high percentage of total revenue from AI in the next few years, because considering that the company's execution capabilities and its past, it may do really well in catching up this AI wave as well. So overall, if you look at this company, so it was an above average quarter. It was, I would not say it's an average, it's slightly above average. It's not a great quarter either. So there is broad-based growth and there is some margin recovery, even though there were restructuring costs. So we may expect margins to remain either stable or increase by 0.5 to 1% in the next 2 quarters of this financial year. So there are a few good deal wins. They have been scaling revenues coming from AI, and they are also focused on cost management, and the margin is always there in their mind. So they are strengthening their positioning in AI and digital transformation. So it's always AI first strategy, and they have already started delivering tangible results. So we have been talking about AI for 2 years, but they have meaningful 3% revenues coming in from AI-based projects. So this looks very interesting for long term. This video is for educational purpose. Do your own due diligence before taking any investing decisions. If you like this video, please like our video. Please subscribe to our channel. Thank you.